Have you ever looked at your 401k, IRA, or retirement account and thought, I did exactly what I was supposed to do? So why does it suddenly feel like I may have created a tax problem in retirement or for my heirs one day? You maxed out the 401k, you deferred taxes, and saved consistently, and you let the markets grow the account. That was responsible, that was disciplined. Frankly, that was prudent. But now you're contemplating retirement, or you just retired and you're not sure what to do. You're not alone. Hi, I'm Jeff Llewellyn. I'm a principal at Rockwood Wealth Management, and my team works with families who have significant financial complexity. Today, I want to walk through what I call the retirement tax trap. Why families who did the right thing for decades can still end up facing surprisingly high taxes later in retirement, and more importantly, what you can actually do about it right now. And stay with me to the end, because I'm going to take you through a real life planning scenario and show you how an actual family might evaluate Roth conversions, Medicare premiums, Social Security timing, and future required distributions all in one coordinated plan. So let's get into it. Here's what makes this issue so frustrating. It usually develops because people did something right. For years, sometimes decades, families contribute heavily to 401ks, IRAs, SEP IRAs, deferred comp plans. And while they're working, the tax savings feel fantastic. Every dollar you put in reduces your taxable income that year. The problem? Eventually, the IRS wants its share. And many families don't realize how large those future taxable balances have become until they're right at retirement's doorstep. I'll often sit with families who have 2, 3 million, sometimes more sitting in tax-deferred accounts. And then we layer in Social Security, maybe a pension, taxable investment income, maybe an inherited IRA, or the sale of a business, and suddenly the retirement tax picture looks bleak and very different from what they expected. Because the issue is not how much money do I have, the issue is where is the money located, how will it be taxed, and who controls the timing of those tax bills. And that brings us to one of the biggest drivers of the problem, required minimum distributions. Because the government doesn't let you defer taxes forever. And at a certain age, and it depends on your birth year, the government requires you to start taking money out of most tax-deferred retirement accounts. These are called required minimum distributions, or RMDs. And every dollar that comes out is generally taxed as ordinary income. For families with significant savings, this creates a cascade of tax bill. I'll give you a real-world scenario. Imagine a family with $2 million in tax-deferred accounts. At 73, the required minimum distributions alone might be around $75,000 or $80,000. Now add Social Security on top of that, maybe another $40,000 to $50,000. Now add a pension, maybe some investment income. You see where this goes very quickly. You're now looking at $150,000 to $200,000 of taxable income a year, not because you chose to take that money out, but because the government told you you had to. And that income doesn't just mean a bigger tax bill. It can mean higher Medicare premiums. It can mean more of your Social Security gets taxed. But above all that, it can mean less flexibility when you need it the most in your financial journey. You might be thinking, hey, but I was told I'll be in a lower tax bracket in retirement. Isn't that what we often say? And sometimes that's true, but for families with substantial retirement savings, it's often not nearly as simple as they expected, especially if markets performed well, which they have for many years. And accounts, they grow, they compound for decades, and before you know it, you have an issue. But there's one thing I do want to talk about. Especially if markets performed well, accounts compounded for decades, or unfortunately, one spouse passes away and their surviving spouse is suddenly filing as a single taxpayer. Which brings me to something that gets far less attention than it deserves. This is the issue that nobody wants to talk about, but it can hit harder than anything else we've discussed so far. It's something called the widow's penalty. Imagine a married couple is retired, they have large retirement accounts. While both spouses are alive, they file jointly. Wider tax brackets, more favorable thresholds. Then one spouse dies. Here's what happens. The income often doesn't drop or change very much. RMDs still have to come out, Social Security is still coming in, and investments still generate income in your taxable accounts. But the tax brackets, they compress dramatically when we move from married to single. I've seen situations where the surviving spouse's tax bill jumps $15,000, even $20,000 a year, not because they suddenly are wealthier or have more income. It's because they lost the joint filing status. And their Medicare premiums, those can jump too, because IRMAA thresholds are lower for single filers. That is why proactive planning matters before a crisis occurs. Because once the surviving spouse is already in that position, many of our best planning opportunities are out the door. So what can families actually do now? Here's the part I really want you to hear. You may have more control than you think. One strategy that often enters the conversation early in retirement is Roth conversion planning. This is not a blanket recommendation. It is not right for every family, but conceptually, a Roth conversion means voluntarily moving money from a tax-deferred retirement account into a Roth account. You pay tax now, intentionally, in exchange for future tax-free growth and more flexibility down the road. The question becomes, would you rather pay some tax strategically today at a rate you understand and can plan around, or potentially face larger forced distributions down the road? There are certain windows where this conversation becomes especially important. Early retirement years, before those RMDs begin. Low income years, perhaps years where the market has a pullback and your portfolio has declined in value, because then you're converting at a lower value. Years where tax brackets are temporarily favorable if something comes out of Washington for a particular year. Let me give you a sense of what this looks like. A family in their early 60s with $1.8 million in tax-deferred accounts. If they strategically convert, say, $80,000 to $100,000 a year over several years into a Roth, they might actually pay taxes at the 24% marginal tax bracket. That could prevent them from being forced down the line into the 32% bracket when those RMDs kick in. Is there a universal answer? No. But families who model these scenarios and carefully plan out the future almost always do better than families who simply ignore it and wait until the pain starts. In a minute, I'm going to walk you through a real-life scenario so you can see exactly how this type of analysis works. But before I do that, I want to say this clearly. If your family has significant financial complexity, large retirement accounts, taxable investments, estate planning issues, a loved one who may need support, or charitable goals, this is exactly the kind of planning conversation my team helps families work through. There is a link in the description and in the top comment where you can schedule a complimentary conversation. Not because every family needs a Roth conversion, they don't, but because families deserve to understand the trade-offs before the tax code makes decisions for them. Now, before we get into that scenario, there are 3 hidden issues I want to put on your radar. The first is IRMAA. If you haven't heard that term, it stands for Income-Related Monthly Adjustment Amount. In plain English, it means if you have a higher income, you will pay more in Medicare premiums. And this catches people off guard because the Medicare premium increase is based on income from prior years. So a Roth conversion, capital gain, large IRA withdrawal, or other income may not just affect your taxes, it may affect your Medicare premiums going forward. The second issue would be inherited IRAs. For many non-spouse beneficiaries, inherited retirement accounts now often have to be emptied within 10 years. That can push taxable income onto your children or other heirs during their highest earning years. So the tax problem may not disappear when you pass away. It may simply move to the next generation. The third issue is charitable and legacy planning. For families who give charitably, tools like qualified charitable distributions, donor-advised funds, and thoughtful beneficiary design can sometimes reduce the tax friction around retirement accounts. But again, the key word is coordination, because each issue by itself is manageable. The problem is when RMDs, Social Security, Medicare premiums, estate planning, and inherited IRA rules are all handled separately. That's when the opportunities are missed. And this might be the most important thing I say in this entire video. Some of the best financial planning outcomes I've seen happen when your financial planning team and your CPA are actively collaborating. Because here's the truth. Investment decisions alone do not solve tax problems, and tax returns alone do not create long-term planning strategy. Because the question is not just, what did we owe last year? The better question is, what are we likely to owe over the next 5, 10, 15, or 20 years? And what decisions can we make today to improve that outcome? The real value comes from forward-looking projections, modeling future scenarios, understanding withdrawal sequencing, coordinating Roth conversion timing, evaluating a multi-year, multi-decade tax strategy, not just looking at the score from last year, but looking at what's coming in the future. The families who navigate this best usually have professionals communicating together instead of operating in separate silos. Because for some families, the financial plan is really a healthcare access plan with money wrapped around it. And when the tax piece and the investment piece and the estate piece are all disconnected, that's when things break down. To tie this all together and show you what thoughtful planning looks like, let's look at a real life scenario. Now, imagine that you have a married couple. We'll call them John and Jane Smith. They just retired at age 60. They have $500,000 in taxable savings, $100,000 in cash, and $3.5 million in combined 401ks and IRAs. Of course, they're going to start Medicare in about 5 years, so they need to develop a Social Security claiming strategy, and they plan to spend roughly $15,000 a month from their portfolio. Given that most of their assets are tax deferred, they realized by working with their advisor that Roth conversions might be the best way to go, but they want more detail before they make a decision. Let's take a look at that exact scenario that I would take them through. Now, John and Jane want to pursue a Roth conversion strategy. Here are the assumptions I just talked through. For ease of explanation, I'm going to have Jane pursue the Roth conversion strategy. But in practice, they would probably both do this. So what we're going to do is have Jane at age 60, 61, and 62 convert about $200,000 into Roth assets. She's then going to bring it down a little bit for reasons I'll explain in a minute. And she's going to finish conversions at age 66, just in time for starting her Social Security at her full retirement age. Here are those assumptions again. We also will assume that the couple will spend about $15,000 per month in retirement plus inflation. So if they pursue that Roth conversion strategy, some real magic can happen in their situation. The thing we're really trying to focus on is bringing down the required minimum distributions. What you see here going left to right over their retirement would be the required distributions and the amount of those. If they do no Roth conversions, these RMDs will get very big over time. But by doing Roth conversions earlier in retirement, we're going to bring that level down because fewer assets will be in the tax-deferred accounts with more moving over to the Roth. But what does that do in terms of taxes, Medicare premiums, and estate planning? Well, on the tax front, what you're going to see here is the marginal tax brackets, and these blue bars are if they do nothing. So what happens is they have very low tax bill the first few years because they're spending from their cash and their taxable assets. So they're not really creating ordinary income. But then for spending, they need to start touching their IRAs. Social Security shows up, so they reduce their distributions from their IRAs. But then right here at age 75, RMDs start kicking in. And it pushes them instantly up toward the top of the 24% bracket. And even later in retirement, they're going to be above that 24% bracket. Here on the far right side, you're seeing the brackets come down. They're compressing. That's the widow's penalty I spoke about, because in this scenario, John passes away. Jane inherits his IRA, so the income stays high, but the brackets compress. Therefore, toward the very end of Jane's life and her financial journey, she's paying a really high tax bill because most of her income is going to be in higher tax brackets. Matter of fact, if I pull up the 32% bracket, she's in that bracket at the end. But by bringing Roth conversions into the conversation early on, we're going to speed up the taxes. We're going to take some higher taxes at lower tax amounts. We're going to fill up the 24% bracket. And that way, when RMDs decrease over time, we can pay a lower tax bill overall. But you might be wondering, what's the net impact on those taxes? Well, here is it in real dollar figures. If they do nothing, they'll pay about $2.5 million in federal taxes from their IRAs. But by converting into Roth early on, they're going to reduce that by about $920,000. Again, because they're going to pay slightly higher taxes early on to save a lot in tax dollars down the road. But how does that affect Medicare premiums? As I explained a few minutes ago, IRMAA is a surcharge on your Medicare premium. So if you get to a certain level of income, you pay more for your health insurance in retirement. Well, by converting Roth assets, John and Jane in this scenario, they're going to save on Medicare premiums as well for Part B and Part D. Matter of fact, they'd save about $62,000 over the course of their plan. Theoretically, they might have to pay a little more toward the end of their Roth conversions, but on the back end, they're saving on premiums. And here's that widow's penalty again, because her compressed brackets at the same income level, her surcharges would be pretty high at the end of her plan. But I also mentioned there's an estate planning consideration for John and Jane. They have kids. And because they want to help out the kids, they don't want to leave a tax burden at the end of their lives. So what they can do with a Roth conversion is they're moving assets into Roths that have no tax burden for their children when they receive it. And that's important because the rules of inherited IRAs today are really restrictive. If I pass an inherited IRA down to my daughter, she has 10 years to take all of it out of that IRA. Well, given the age difference between first generation and second generation, the kids might be receiving those taxable assets in their highest earning years and paying the highest marginal tax rate. What John and Jane can do is really make it a better experience for their family to take care of them. If they do nothing as far as Roth conversions, what would happen is at the end of their plan, they'd have about $13 million based on all the assumptions. But most of those assets, about $7 million of it, would be in tax-deferred assets, IRAs, things like that. The kids would receive those IRAs and have 10 years to empty them and pay the taxes on that roughly $7 million. But by doing Roth conversions, we still have about $13 million in the portfolio, but now $6.5 million of it is in a Roth that is tax-free to the second generation. And that is a great way to take care of your kids and the ones you care about at the end of your plan when you don't need the money anymore. So here's the bottom line. Doing the right thing for decades does not automatically guarantee the best retirement outcome. You can save diligently, invest responsibly, defer taxes exactly the way you were told to, and still reach retirement with a tax problem that needs to be managed. But the good news is you have options. The families who navigate this best usually do not wait until RMDs begin. They model the future. They coordinate with their CPA, they think through Medicare, Social Security, estate planning, and legacy goals, and make decisions that maximize the opportunity to achieve those goals. And if your family has meaningful complexity and you want help thinking through these moving pieces, I'd be happy to have a conversation. There is a link in the description and in the top comment where you can schedule a consultation. This work is personal for me. It is not theoretical. And it's not just numbers on a spreadsheet. It's about helping families make thoughtful decisions before planning windows close. If this was helpful, please share, like, and subscribe. And I'll see you in the next video where we're going to talk about the 5 financial decisions wealthy families should never make alone. Several of them tie directly into what we discussed today. Thanks for watching.